There. Good morning or good afternoon, depending on where you are. I'm Chris Hanson. Wanted to thank you for coming to the Hanson Capital Opportunity Fund 3 webinar today. We're going to focus on Series 2, which is the third property and second offering that we're putting into this third fund. Today, I've got Chris Pike, Managing Director of Acquisitions with me, as well as Ted Ost, the Managing Director of Investor Relations. We're going to cover some background, some progress on the fund, as well as this specific opportunity, and we'll wrap it up with Q&A for anything that comes up over the course of the webinar. With that, Ted, go ahead.
Awesome. Thanks, Chris. As Chris mentioned, my name is Ted Ost. I'm the Managing Director of Investor Relations here with Hanson Capital. We're a real estate investment firm based here in Scottsdale. For those of you not familiar with Hanson, we focus on acquiring small bay industrial properties throughout the Southwest. This type of investing, we're essentially looking for warehouses in areas with strong population growth, with easy access to major freeways, railways, or ports. We're particularly excited about an opportunity we have that we're going to be closing on here in December. It's the Murphy Business Center in Houston. As with any investing opportunities we discuss will entail risk. We do our best to thoroughly underwrite our deals, as well as hire the best in-class legal and tax consultants. We always encourage our attendees to seek input from their own tax and legal counsel. Past performance does not guarantee future results. We'll go through the company background, our advantage, the fund structure, the opportunity we have today with Murphy, as well as a bit more on the fund. And we'll save some time at the end for questions and answers. So if you have any questions, please enter them into the chat, and we'll do our best to get to all of them at the end. Our principal, Chris Hanson, came out of the mortgage business in 2008. He bought his first property at auction with a cash advance on his credit card and realized there was a business here. So he went out and began buying single-family homes at auction. He aggregated the homes into portfolios, sold them off to institutions. He also bought apartments. In 2018, he bought his first industrial property. He pivoted from multifamily to industrial, began heavily in 2020 and 21, and we're currently in the process of negotiating a sale with JP Morgan. Chris, would you be able to go a little bit further on the JP Morgan transaction?
Yeah, absolutely. Really exciting and kind of validation for us on our first fund. The first fund of industrial, we bought 18 assets, and right now we're working on a transaction with JP Morgan where they've gone contingent free or released their contingencies to buy 8 of those assets. Not only is that validation for our strategy of buying existing industrial and infill assets below replacement cost with below market rents, it's also validation on the assemblage play. I've done that with residential assets as well as multifamily throughout the history of Hanson Capital Group. And now to get JP Morgan as a buyer is kind of a big gold star on the resume. None of these individual assets would have been appropriate or attractive to them, but the assembled portfolio is what institutions fought over, and JP Morgan ended up paying more than the others. That's led to our next phase, which is the benefit of having the scale that we've achieved. We're just over 350 million of total assets under management today. That came from a decision back in 2018 where I had previously been mostly operating as a service provider to external investors, but managing investments on behalf of my own account. Back in 18, I decided to open it up from beyond just friends and family and bring in additional high net worth investors to get some more scale. What that's resulted in is I'm still our single largest investor, 27% of total assets under management, but we've gotten a scale where we've got institutional abilities and qualities while still being small enough and nimble to go after opportunities as they present themselves. So everybody on our team is heavily invested and knows that it's a privilege to be able to work on these opportunities on behalf of not just our own capital, but our partners like yourselves that come to invest alongside us. Part of that differentiation today is the full vertical integration. As we've gotten to that scale, we've been able to add kind of market leading or industry leading people and professionals at each sector of the business model. So Chris is leading a team of 6 in acquisitions. We've got a lending department, which gives us better and more strategic capital markets decisions. We've got Jim Tainer running property services. He's got 40 years in the property management business, including managing director of investor or asset management at several billion-dollar single-family offices. He's brought a whole bunch of talent and knowledge base to our property sector that creates a differentiating result, as well as Michelle Tesfaye, 16 years in property accounting. She's got multiple CPAs working under her. We've got internal legal. We've got a full vertical integration, which leads to a better asset performance. Last thing I want to touch on before I hand it to Pike on the specifics of the opportunity is our fund structure is really transparent and really clear. A lot of people make this a little more complicated than it needs to be, and sometimes it's a little murky. We've got 3 fees we charge. We charge 2 points when we buy something. We charge a 1% asset management. Crucially, that's just on the equity raised. It's not on the entire deal value. That's something that a lot of our peers do. Asset management is meant to cover the overhead to keep us in business. It's not meant to be a profit center. And lastly, disposition. We charge a 1 point fee when we sell something. As far as the actual splits of profits, we take 30% at the company level, and then we take 70% to our partners. And crucially, I am on the partner side, knowing that I'm kind of in the middle of this organization. I invest as a limited partner, the same as you guys do, which makes sure that our interests are always aligned, because I'm going to be making decisions for the LP or limited partner side of the table, because my money's on that side of the table alongside yours. A lot of our peers as well give a little bit more preferential treatment to themselves than the limited partners in the deal. And I think it's critical that I'm aligned as the managing partner with the LP capital. So that's where I put my own capital. With that, I'm going to hand it to Chris Pike to talk about the specific opportunity we're seeing in the industrial space today. Go ahead.
Thanks, Chris. So for those of you that are not familiar with small bay terminology, what we mean when we say small bay industrial assets is we're talking about multi-tenant industrial business parks. We're focusing on bay sizes anywhere from 1,000 to 25,000 square feet. And the typical tenant profile for these business parks includes contractors, some light manufacturers, as well as last mile distribution services. The reason we're focused on this subsector of industrial real estate is there's a massive lack of supply in this segment. As you can see in this chart here, the recent supply pipeline, less than 2% of the recent supply pipeline has serviced bay sizes under 25,000 square feet. A majority of the new construction has been servicing bays greater than 100,000 square feet for bigger bulk distribution type product. What this has led to is tight vacancy rates for small bay product. You can see here, on average across the country, bay sizes under 25,000 square feet have vacancy rates hovering around 2%, versus the bigger box product has vacancy rates anywhere between 7 and 10%, depending on the bay size and the specific submarket. This supply-demand imbalance has led to extremely strong rent growth for the small bay industrial space. This red line in this graph here is asking rates for bay sizes under 25,000 square feet, and you've seen continued strong rent growth over time for the small bay product. On the opposite end of that spectrum, the purple line is bay sizes over 200,000 square feet, and you can see that asking rates for bigger box product that has been the glut of the new supply, the rents have started to flatten, even soften in submarkets with oversupply. So where we see opportunity in small bay industrial real estate is historically there's been limited institutional competition. These larger institutions prefer managing single tenant assets rather than a multi-tenant business park. They want to efficiently move capital with less management headaches. So they've been focused on larger single tenant assets rather than multi-tenant business parks. And this has led to fragmented ownership or a lot of unsophisticated ownership in the small bay market. When I say unsophisticated, it doesn't necessarily mean these are not intelligent people, but a lot of times it's people that have owned an asset forever at an extremely low basis, or maybe they've inherited a property and they've been in a position where they'd rather maintain their existing occupancy and maintain a friendly relationship with their tenants rather than pushing rents and keeping up with market rates. So this gives us an opportunity to acquire these assets, implement strategic improvements, push rents to market, as well as implementing more institutional management structures that allow us to drive bottom line revenue and force some appreciation. Another differentiating factor for our platform is our extensive deal sourcing pipeline. Right? We employ comprehensive marketing efforts between phone calls, texts, emails to stay top of mind with over 1,300 brokers across the country. Typical month, we see roughly 1,000 opportunities come across our plate. 10 to 20% of those check our buy box requirements and warrant a full underwrite. This leads to roughly 5 to 10 offers per month, depending on the month. And ultimately, we're securing one deal per roughly 2,000 opportunities that get sent to us. This is a systematic approach to reviewing a large volume of opportunities, and this allows us to distinguish the best opportunities in the market that are coming across our plate. This selectivity also led us to pausing our buying activity from, call it mid-22 to the middle of 2025. Right? And it's not because we stopped working or stopped looking at opportunities. Deals were simply not penciling to where our leadership team was comfortable with moving forward. I think you'd be hard pressed to find other sponsors in the space that took that same pause over that same time frame for that reason. So I'm excited to talk about the Murphy Business Center, which is Series 2 within our Fund 3. Any deal that we're looking for our Fund 3 has to meet two specific requirements. We want to buy below replacement cost, and the second is we're looking for in-place revenue that's below market. If a deal doesn't meet these two strict criteria, we're not chasing it, period. And we're excited because Murphy fits both of these criteria. So I want to talk you through why we're excited about the Murphy Business Center. The first is because we're buying well below replacement cost, as I just mentioned. We're requiring this asset at a basis of $101 a square foot. Replacement cost for this type of asset in Houston would be closer to $140 a square foot. That's if you could find the dirt. The city of Stafford is one of the few submarkets in Houston that has zoning regulations, and they're not allowing further development of this business park type product today. So you can't find the dirt to replace it, but even if you could, you're looking at a cost of $140 a square foot versus our basis of $101 a square foot. In addition, we love the infill location of this asset. It's located smack dab in the middle of three major freeways, the Beltway 8, the 90, and the 69. So it's got easy access to freeways that get you throughout the entire Metro Houston. It also has frontage on a major thoroughfare of Murphy Road. Murphy Road is a major thoroughfare within the city of Stafford that provides a lot of eyeballs and high traffic counts for a great exposure for our tenant base from their customer base. Also, there's some strong differentiators within this business park. It's got attractive bay sizes ranging anywhere from 1,200 to 18,000 square feet. So this is an ideal business park setup. It allows tenants to grow and expand within the business park. Someone may start at a 2,000 square foot bay, and as their business continues to grow and expand, they can relocate to a bay within the business park rather than having to completely relocate to another business park in a different area of town. In addition, there's some ideal build outs within each bay. Like there's very minimal office build out, which is very attractive to tenant base. And it also has some features like secured yards for the larger bay sizes. So all these add up to a lot of attractive components within, it's a very attractive product type for tenant demand today. So the business plan or where the opportunity lies within the Murphy Business Center. Currently, the current ownership has not been executing make-ready improvements on their existing vacancies, and rather has been trying to incentivize prospective tenants with abated rents, which is not as an effective strategy, right? For these small bay spaces, executing make-ready improvements is a critical component to minimizing downtime as well as maximizing lease revenue. A lot of these small bay tenants, they're not planning their moves 12 months in advance. A lot of times they need space now, right? So they don't have 2 or 3 months for you to, make a build out custom to them. They need move-in ready space that they can start operating in yesterday. And so these guys have been missing out on a lot of tenant opportunities by waiting to execute these make-ready improvements. The reason they haven't been executing these make-ready improvements is they spent a lot of their capital improvement budget, or a majority of the capital improvement budget, on some fire life safety requirements that the city of Stafford implemented upon them. And therefore, a lot of their budget that they had set aside for these make-ready improvements is gone or no longer available. So this has created a significant vacancy factor at the property today. They're at 16% vacancy, which is well above the submarket average. We're typically seeing 3 to 5% depending on bay size and business park. And so this creates an opportunity for us to acquire the asset with some strong in-place cash flow, execute the make-ready improvements on existing vacancies, and lease them up at demonstrated market rents within the park to drive yield. Another reason we're extremely excited about this opportunity, it's the first time in a long time where we've been able to acquire an asset with an in-place yield that's above our cost of capital. So we're buying it at an in-place 6.6 cap versus our cost of debt is at 6.4%. So we're able to arbitrage our cost of capital day one and create positive cash flow day one with a true value add opportunity through execution of make readies and lease up on the existing vacancies. So returns overview, we acquired this asset or acquiring it for roughly 34.6 million. We have a budget of 1.65 million for make ready improvements. We're placing a loan that's 60% loan to cost with a 5-year fixed rate at 6.4% interest with no prepayment penalty. So we've got a lot of flexibility in terms of our exit here, having no prepayment penalty. Loans at this type of fixed rate with that flexibility are typically not attainable without our banking relationships, right? We're one of our bank's largest customers. In addition to that, they're getting a lot of comfortability with Hanson signing a personal guarantee on this loan. And as discussed previously, when our owners signing personal guarantees on acquisitions, it shows a significant amount of dedication and conviction and execution of an asset and a business plan. From a cash on cash standpoint, upon full stabilization of the asset, we're projecting cash on cash returns of 7.2% to 9.6%, depending on the class of investor. And then we're looking at a 20% IRR and a 1.4 equity multiple on a 2-year execution. I appreciate you guys taking the time to hear me out about this opportunity. We're always happy to dive in further on the underwriting or specific questions on a separate call, which you can book with myself or Ted after this presentation. But with that, I'll kick it back to Chris Hanson.
Thank you, Chris. Again, that's fast paced. We don't want to take 3 hours to explain what's going on today. I really want to thank everybody for showing up and spending this time with us to hear about what we're working on. I'm really excited about this deal because it hits those basics that we put and implemented on our first fund. We've got to buy in place below market rents. We've got to buy below replacement costs. Those two things should keep us safe through virtually any environment. Being able to buy that positive debt arbitrage at closing is what really got us into industrial in the first place. And, it has been a painful few years, but we'd way rather take a disciplined approach and not deploy the money. We get phone calls from investors sometimes over the last couple of years saying, "Hey, Hanson, I really want to put the money out. I've got all these other opportunities," and we haven't seen anything that has been worth buying. That discipline is something we're proud of. Today, we're really excited about the basis here. I'm putting a pretty substantial multi-million-dollar investment in personally myself. We've also got that flexible exit option, the ability to break this into smaller pieces and sell into smaller chunks if that is accretive to the deal. Or, as I mentioned on that JP Morgan transaction, the ability to assemble these. This will make the 5th multi-tenant building of this profile that we own. We think when we get about 1 million square feet of that, it's a really attractive target for the publicly traded REITs, the institutions. But more importantly, this is an asset that with a yield that's, in the 8-9%, nearly 10% cash on cash, I'd be comfortable holding for a longer duration if we saw any other surprises in the economy. So we're really focused on cash flow and yield that we could distribute. And this asset we're looking to close December 4th. So we're about 3 weeks away. This will be the final push. And again, thank you guys for showing up today. I'll open it up to Q&A now. I think Ted has sent me a note. We've got a number of questions so far. And
we got a few. Anybody, if you have any questions, please enter them in. I'll start going through a couple that have already come in, but we've got some time left here, so be sure to ask any if we don't get them covered. The first question is my investment into a fund or into this specific deal?
Good question. The investment is into our third fund, but it's specifically Series 2. We run a series limited partnership structure. It's kind of a more modern entity type and structure, which allows us to operate a fund that repeats and reuses the same securities documents, but we're able to silo specific assets. So there's a K1 distributed to each partner that contributes into this series, and this will be the only asset. So if you make an investment into Series 2, it's going to be into the Murphy asset and only this deal. The reason we run that structure is a lot of our investments or family office partners will put an investment into every deal that we do. And this makes the subsequent or follow-on investments a lot easier. Your lawyers and tax professionals don't have to get familiar with an entirely new PPM and offering structure. You just make an additional investment into Fund 3, into the next series, or skip Series 3 and do Series 4. It just makes it more efficient for everybody.
Cool. Why do you guys like multi-tenant properties better than single-tenant properties?
When we first started buying industrial, we did buy mostly single tenant, but we also had some multi-tenant stuff. I like the multi-tenant nature because it operates a little more like an apartment complex. And when I say that, I mean with a multi-tenant property, our rents are diversified. In this case, I think we have 114 tenants. So if we had a few that didn't pay on any given month, or were facing collection issues or something, which is going to happen in part of the business, hopefully the other 110 are paying. Whereas when you're in a single tenant scenario, it's kind of an all or nothing scenario, and that works great. We own both, but I'm cautious on the macro economy outlook today, and the multi-tenant makes more sense to me. That's why we're focused on it.
Perfect. Pike, this one might be a good one for you to answer. Is the building in a floodplain?
Yeah, so currently the building's not in a floodplain. We've got this already fully vetted by our insurance company with additional wind, hail, and hurricane buy downs as well to minimize our exposure for hurricanes and flooding in the area, but it is not in a floodplain.
Got it. Any issues with the water and sewer in the area?
No, not today. No issues with water or sewer as well. It's fully serviced with water and sewer through the municipality, and no issues with access to water or sewer.
Perfect. And are all existing leases net?
Yeah, majority, not 100%, but 90, I call it 95% of existing leases that are in place have already been converted to net leases, which is great. Like, we anticipate a stronger than normal renewal ratio on the existing in place tenants. The true value add opportunity, there's a slight mark to market on the existing rent roll, but the true value add opportunity here is executing the lease up on existing vacancies.
Perfect. Are investors exposed to any potential loss beyond the amount of their investment?
No, the structure, the general partner, limited partner structure itself, we all invest, including myself, on the limited partner side of the table. That legal structure is not new. The operational kind of liability created from running the property starts with property management and kind of ends or lands with decision makers. So we set up an investment manager that is kind of a layer in between, and then we isolate all of our investment, myself included, on the limited partner side. Therefore, we don't have any operational control as limited partners, which preserves our limited liability protection through the legal system. As far as exposure beyond the investment, I'm taking guarantee risk on performance at the loan level. That's being guaranteed by my balance sheet. The dollars we're contributing as LPs are at risk, like any investment, but exposure beyond that would be incredibly rare or difficult to create.
Perfect. What type of communication and updates will I see about the investments I am in?
Great. That's another great question. We send money, we distribute cash flow, operational performance on a monthly basis. So you get automated emails through our system of, hey, this investment, and you get one of those for every investment you're in. You don't just get a lump sum. As people invest in more deals, they get more payments every month. I like to get paid monthly. Our accounting team completes financials every month. We don't see a reason, although most institutional or larger PE groups focus on quarterly distributions, quarterly communication. We stick to monthly for distributions of cash flow. We stick to quarterly for updates. We write a written narrative with some photos and anything we think is relevant to share to the partners on a quarterly basis. That being said, when there are extraordinary things that happen, we communicate off cadence, as necessary.
Cool. Pike, this one's a good one for you. When there's a vacancy, what's the expected time to lease up, and who handles this?
Yeah, so we're underwriting 9 months of downtime upon vacancy, plus an additional 1 month of abated rent to the new tenant, right? So what happens is, we deal with that transition of having our general contractors, if we know there's a vacancy upcoming, our general contractor will begin quoting the make-ready improvement cost before that tenant even leaves the property, so we can hit the ground running in terms of doing the make-ready improvements day one upon vacancy. Say it takes anywhere from 30 to 60 days to get that capital improvement plan completed, depending on the condition of the bay when we receive it. And then we're utilizing boots on the ground, third-party leasing brokers to run the marketing and lease up of those bays. But to answer your original question, 9 months of downtime and plus an additional month of abated rent for a new tenant when they sign.
Perfect. This one's from Paul. I need depreciation in 2025. Will you guys do a cost segregation for 2025 K1?
Yeah, we run cost segregation studies on every asset. We already have estimates from our partner who conducts those. The K1 that we distribute kind of in 2026 will reflect that. I think they're anticipating roughly 6.5 million in depreciation. They also have a habit of outperforming their expectation, so we'll be distributing that pro rata amongst the partners. It's pretty typical for our year one investment to show a loss of capital because we lean heavily on optimizing tax efficiency.
Perfect. And I think we have time for one more. This one's from Stuart Pike. I'd like you to get this one. What is the exit plan?
Yeah, as Hanson mentioned earlier, we have some flexibility here, right? The property is split into two separate parcels. So we have the ability to, upon stabilization of the asset, to exit as two individual assets if the market's more creative to selling smaller chunks. We're also acquiring a significant number of these small bay assets and already own a significant number of these small bay assets. So we'll also constantly be monitoring an opportunity to see if there is a more accretive exit through an aggregation play, as we mentioned. But the way we're underwriting it today is a single asset execution on a 2-year timeline and selling upon execution. If for any reason that, if the market goes against us or macroeconomic shift drastically where it makes more sense for us to hold on to it until there's more buyers in the market or more creative time to sell, we're not going to, punitively force ourselves to sell. But we do like the flexibility and exit here. And today we're underwriting an individual asset sale at the end of 2 years.
Great. One last question. Along with the vacancy question, the buildings seem narrow with limited height. How does this compare with the market and newer product that has higher clear heights?
Yeah, I think the question there is saying, hey, this looks like older product. How does that compare with new product? We actually love this older infill product specifically because it wouldn't pencil to develop this today. You could see in some of the photos, and we show in the photo on our offering site, everything surrounding this product is newer, higher clear height, and it's maximizing lot coverage. So to go execute a successful development today, you've got to maximize your revenue potential out of your costs, being your dirt and your building. These particular buildings are not being built and haven't been being built, as Chris Pike was going over with the supply side of it, because they're low density by nature. They've got the drive lanes, and clear height has steadily risen over the last 10 or 20 years. And that's because of more sophisticated distribution methods where guys are racking things. And if you can go up, that can be a little more efficient cost-wise than going out wider. But this type of product for these smaller bays, these are not going to be Amazon distribution facilities. So at 18 feet, that's a great clear height. You can do some racking. You can get 2 layers of stuff in there. So it's not an obsolete product. And in fact, the location within infill nature is always going to be in demand. And we feel protected that there's no new supply coming online for this specific product. That's part of why we like it so much. So the lower clear heights are not an issue, and the lower density is kind of a benefit. I think we've hit everything in the queue. With that, again, I really appreciate everybody spending their time with us. If there are any other questions, feel free to reach out and email. We've got about 3 weeks till closing. We're calling capital from our partners that haven't already contributed over the next 10 to 15 days. And we look forward to you guys joining us in a future investment, if not this one. Thanks again.